One of the more common questions these days are, should you invest in index funds at an all-time high? Should we even invest at all at an all-time high? Those are the questions I ask myself constantly throughout this year, since about half of my portfolio is actually in index funds or ETFs. You can imagine why I'm a little nervous, since market crash videos or articles are literally everywhere. And they generally come with a massive red circle around how high the Sheila PE is right now, or the market value to GDP ratio is 2 standard deviation above the norm, or margin debt is at an all-time high, and the last time it was that high, we had a correction or market crash pretty soon after that. I can go on and on, but you get the point. It's pretty scary stuff. So in this video, I want to show you what I found by going deep into the internet rabbit hole and my own conclusions whether I should continue investing at an all-time high. As usual, I want you to know that I came to my own conclusion given my own circumstances. You're going to have to make up your own mind. And no, this video is not financial advice or recommendation to do anything. So without further ado, let's go. A really interesting place to start answering this question is, let's say David is an idiot and he only invests at market tops. What will happen if he only invests at market tops? It turns out that JP Morgan did an exact study where they looked at S&P 500 over the last 30 years from 1988 to 2020 and compared the performance differences if you were to invest at all-time highs versus investing in non-all-time highs. So the result was really interesting to say the least. And if an investor was to invest on any day, basically not all-time high days, the cumulative total returns after 1 year is around 11%, 39% after 3 years, 5 years is around 71% on average. But investing in all-time highs, it's around 14% after 1 year, 50% after 3 years, and 78% after 5 years. Now, of course, past performance doesn't indicate what's going to happen in the future. It might not happen the exact same way in the future, but looking at this study, it was pretty mind-blowing to say the least. StockSpot did a similar study looking at the Australian market between 1989 to 2019 at the average capital return before dividends over the next 12 months. You can see that investing on all-time high days somehow yielded a little bit of a better result compared to invest on non-all-time high days. Look, if you had a Jackie Chan type WTF moment, don't worry, me too. When I first discovered these studies, I couldn't really believe what I saw. What's even more interesting is that if we plot the S&P 500 on a chart and put red dots on all of the all-time highs, it seems that all-time highs are generally followed by more all-time highs. But sometimes the market gets completely out of whack because of people getting too greedy like the GFC, or speculation around a new tech that will change the world when the world isn't ready for the tech, like the dot-com bust. And I guess that's the main concern right now because most people are afraid of a major crash because of the massive rally we went on recently. Some of the comments on my videos from earlier this year, the sentiment that I got is that some investors believe they can time the market by essentially selling at the top and then re-entering at the bottom. But my question is, how many investors actually have the emotional discipline to re-enter at the bottom? Well, to be perfectly honest, I don't think that many people have the emotional discipline to buy back at the bottom because it could keep falling. What really scares me as a retail investor is not a market crash. It's the fact that if I just miss 10 of its best trading days for my Australian shares, a little bit over 40% of my long-term gains will be completely wiped. Now, that picture doesn't get any better for US shares because missing 10 best days means that I will lose out on a little bit less than 50% of my long-term gain. So if you were to ask me, the odds are really not in my favor if I were to try time the market. And that's not even taking into account the tax consequences of liquidating your entire portfolio and then trying to re-enter at a point that you think is the bottom. To put things in more perspective, a wealth of common sense created this entire table where they looked at the major drawdowns in US stock market and how many years it took to recover from those drawdowns. Now, the Great Depression was an outlier because it impacted everyone, and it took 13 years to recover an 86% drawdown. That's massive. That's like crypto numbers, if you will. But besides that, the rest of the other drawdowns or corrections takes on average around 2 years to recover from. There's always going to be outliers, and the ones that we're most familiar with when it comes to major crashes are the dot-com bust, which had a 49% drawdown, and the GFC that had a 56-57% drawdown, and it took respectively 4 and 3 years to recover from. Now, one of the main reasons why we were able to recover from GFC, even though we had a bigger correction then, in 3 years, is because we started quantitative easing programs right after the GFC. And that is known as money printing. That's also one of the reasons why we're able to recover from a pandemic crash in less than a year, because of both government stimulus and loose monetary policy. So what we just looked at is the S&P 500. What if we look at NASDAQ 100, which were really impacted by the dot-com buzz? So say David only invested towards the peak of this bubble, and he's a complete idiot, and he didn't invest any other time. This would have taken approximately, I believe, 15 to 16 years. So approximately 16 years to recover from, to get back to the previous height, that is. But as many of you know, I am not an invest a lump sum kind of guy. I am more of an invest consistently kind of guy. The more I earn, the more I'm going to invest every single month. So it's very likely that my expected returns on the way down this dot-com bust would have looked better and better. And I'll give you an example. Let's say towards the end of 2000, instead of taking 16 years, it might have taken only about, say, 12 years to recover from, right? And then say towards the beginning of 2001, instead of taking 16 years or 14 years to recover from, it might only take around 7 years. And then obviously, if I was alive and I even understood what investing actually meant, and I invested consistently throughout, especially the bottom of this dot-com bust, then the expected returns over the next 10-20 years would have looked amazing. Of course, everything depends on your investment horizon. I am in my late 20s, which means I have more than 40 years of investment horizon left. And this process works for me just because my investment horizon is so long. But it might not work for you. And that's why in the beginning of this video, I mentioned that I have come to conclusion for my own circumstances. And you have to navigate this world based on your own circumstances and come to your own conclusion. But what I'm ultimately trying to do, at least with the passive side of my portfolio, is to be part of this group of people and not part of this group of people. I just don't want to time the market and think that I am smarter than everyone else, that I can time my top and bottom really precisely. I just don't think I can do that. And I much prefer for the passive side of my portfolio to really focus on consistently investing and not really take gambles like that where the odds are significantly against me. Now, if you're interested to know how I built my own bulletproof portfolio, feel free to check out this video right here or in the description box below. I have documented my entire process with a lot of references to Pokemon, so consider watching that video after this one. Thank you so much for hanging out with me all the way to the end. If you did learn something new, consider gently smacking the like button right there. Subscribe to my channel, click onto the bell so that when I release future videos, I can let you know. If you're still bored, I left a video on the screen that I think it's incredible to watch next. And as usual, Otto will always do the honors, and I'm gonna see you very soon.